meet with people that have significant amounts of money, and the people we just got as clients that have well over $1 million, and they had 30 mutual funds.
I purposely picked 5 different ones. They all had mainly the magnificent
Nvidia, Microsoft, Amazon, Apple, Netflix, over and over and over again.
Your correlation is 1.
If you're looking at your statement and you have 250,000, 500,000, $1 million or more, all in mutual funds or ETFs, you definitely need to call us. Hello and welcome to the Wise Money Guys radio show. I'm your co-host, John Scambry. I'm here with my partner extraordinaire,
Giuseppe Visconti,
certified portfolio manager, masters in economics and finance, chartered retirement planning counselor. What else? Undergrad from San Francisco University of San Francisco in economics, or was it finance?
Business economics.
Business economics. I mean, you need more alphabet soup behind your name.
I like snickerdoodles, long walks on the beach.
And as I said, we are certified portfolio managers, if I didn't say that. And what that basically means is we're different, in my opinion, better than your typical financial advisor. In fact, over and over and over again, we meet with people that have significant amounts of money, and they have the people we just got as clients that have well over $1 million,
right?
And they had 30 mutual funds. And then when you looked
ETFs and mutual funds,
you looked into the mutual funds. Granted, they were different brands.
I randomly picked 5 from the roster that all had to do with equity because I knew they were all 100% equities exposure. I picked 5, and it wasn't set up. We did it live with the client.
Oh yeah. We didn't even, we just
explaining
funds.
Yeah. Just explaining. And they're all different brands. And so to the client's naked eye, it's one's Vanguard, one's T. Rowe Price, one's, JP Morgan. So they probably have different stuff. I'm diversified, but I purposely picked 5 different ones. Right. And we picked different brand names and went through the top holdings and said, here, let's go through the top holdings. And I think a few of them or a couple of them had a little bit different top holdings, but they all had mainly the magnificent
Nvidia, Microsoft, Amazon, Google, Apple, Netflix, over and over and over again.
Right. And we were explaining to them, like we've explained several times on this radio show and podcast, that sometimes when you have a glimpse of your portfolio and you have all these different names and they can be phrased or titled differently, or it could be different investment firms, like we mentioned, it could be Fidelity and Vanguard and whatever, growth equity fund, U.S. equity fund,
equity income fund.
Yeah. But then you look into the top holdings, which is going to be the higher weighted or more important names of that fund, because it'll move that fund more. And when you have a lot of the very same things across multiple funds within your same portfolio, your correlation is 1.
Yeah. So just to throw this out there early on in this conversation this morning, if you're looking at your statement and you have 250,000, 500,000, $1 million or more, all in mutual funds or ETFs, you definitely need to call us for a no obligation consultation, because you don't and probably have much and a lot of overlap that you don't even realize,
right?
Which means you're not diversified. And certainly you're not getting the skill set and value proposition and service model and expertise that Giuseppe and I have for building custom portfolios, your own mutual fund, if you will,
right,
when you have means. And so call us at 916-967-3500. We got to dive in to the earnings, because this is the game we play. This is the game that the industry plays, that, it's always about the expectation of the future value is based on the expectation of earnings growth,
and
either
delivering,
continuing or not continuing.
Yeah.
Right.
So does does this earnings season support this rally that we've had since the lows of April?
So far from what we've seen, and so if you don't mind going over a couple of these, but let me mention the one that I was alluding to when I was walking through what we were going to talk about. So it was Tesla that, I mean, without the subsidies, which are ending,
Right.
Inventories are now high. Profit margin is down on Tesla. Tesla's always traded like an AI or a tech company.
Yes.
But
you're talking about the auto.
Right. Fundamentally, the cars are still the major portion of, what makes up its earnings and what drives its stock price to way beyond what a typical, GM,
right.
Ford,
because it's definitely not typical.
Stellantis, those types of things.
Yeah.
And so, do you buy Tesla here? I would say, wait for a few more days. I'm not selling the put yet.
Fundamentally, it still shows overvalued. Fundamentally, you just look at fundamentals on the Tesla and earnings and the report, the stuff that's being reported, which is on the autos, it's still at its current price shows overvalued.
Yeah.
So I think more of a fair value from what I've seen and read out there is more like $265 a share.
But Apple has just been ho-hum. And because Apple is such a large weighting of the Dow 30, if Apple doesn't go through the roof, the Dow's not going to set records. I mean, it's possible with Microsoft. And
there's been rumors that Tim Cook is going to be leaving. So I don't know if there's any validity to that or not, but there just hasn't been much innovation.
There's none.
Versus when Steve Jobs was running the show.
I don't know about you, but people look at my folding
Me too.
phone all the time and go,
you looked at mine, which made you, which you had an iPhone before. And that's exactly now you're experiencing it.
Yes. And so many people are so hopeful that it's an Apple. They go, is that Apple? I go, no, not even close. Apple hasn't come out with a new thing. And this whole thing of, what are we going to be on the iPhone 700 before they, you know what I mean? Because now twice a year, it seems like it was just the 15, last year sometime. And then the 16 came out, then the 17 came out.
No, 16 Pro.
Whatever.
Well, they do like a 16 and the 16 Pro and the 15, the 15 Max.
But it'll be the 17 and the 18 and the 25 and same format. And it's just tired. I mean, I just can't fathom how you can have a entity, if you will, an agency,
independent branch,
without tax holder or at least without congressional approval or oversight, just decide that, hey, we're going to spend $2.5 billion just renovating our 1930s building.
They're flexing and abusing their independence, right? The whole idea of the Federal Reserve is to be independent and not have any affiliation or influence from the political bodies in that, term or period of time. And they can solely make decisions, but that's outlandish.
Yeah. I mean, I think this is a perfect cause for redrawing whatever the doctrine of the Fed is that Congress originally created, decades and decades ago, because, one person, one committee, the FOMC, the Federal Open Market Committee, should not have this sort of unelected power,
Freudian slip
over the world, quite frankly.
Yeah.
I mean, think about it. It's over the world. It's not just over the U.S. economy. It's over the world.
When the FOMC meeting happens, like every other major country kind of definitely stops and listens.
Yep. And when you see a person that thinks it's okay to literally build something more expensive than what the Dallas Cowboys spent on their stadium, think of how massive a football stadium is,
huge,
and how many acres that involves. And the Fed remodel
and the infrastructure
is more expensive. It's going to be $3.2 billion. I mean, clearly that's an out of control entity that has no oversight. There is oversight, but it was all run by Obama appointees. The national, I forget what it is. Somebody will probably call us or email us and help us with
the National Spending Committee.
That's basically what it is. There's an oversight committee on the budget.
It's the NSC.
Isn't it interesting in 2020 that the budget was put in to Obama and appointees that go back to Obama, and that of course the director, I believe, was a Biden appointee, and they approve a $2.5 billion remodel. And interestingly,
it's going more than that, right?
Yeah, $700 million over budget. And
why would so? I think if you're going to just blow that money on a remodel, why not take that $3.2 billion and go find all of the small businesses that were forced to be shut down during the COVID
fraud
chaos,
the COVID fraud
that happened, and then ended up permanently having to close and lose their livelihoods? Why don't you go and find a way to incentivize those small businesses
to reopen,
and entrepreneurs to reopen and have like a very low interest or a no interest, some sort of not to just give it away, right? Because that's not an incentive, but some sort of incentive to let them borrow to rebuild the business that they lost. I think the lesson, though, is clear, is when something is government driven and forced down people or heavily influenced or encouraged down private sector's throats, it doesn't work. There's a bigger track record of things not working and coming to fruition than the opposite, and versus letting the market be free and really produce goods and services for the society out there. And the demand is going to drive the success of that. If people like it and it serves the needs and wants of people, then it will thrive. If it doesn't, it will fail. But when you have government coming in and saying, well, we're going to come out with this mandate, we saw it with EV, electric vehicles. We saw, and we've had plenty of conversations on that previous episodes, and the failure, the highlight was basically the Ford Lightning truck and how much of a failure that was. You're seeing a lot of manufacturers now going against it. If it was so great, now the current administration is saying, no, we're doing away with that. But if it was so great, they would continue to push towards that. But that's not what they're doing.
Yeah, dare I say it, though? I think, I mean, you can't.
I don't dare you.
You can't discount EV cars, obviously, entirely. The mandates and all the things you were saying.
I'm saying it's government driven.
Government and taking free markets and capitalistic.
And we saw it with ESG. We saw it with some of the woke stuff. You saw Target, Budweiser, Lowe's.
Yeah.
And all the narrative that they wanted them to drive.
My thought is, once you get something that so we were talking about Lucid, and they've got that car that will do a 500 mile range,
right?
But it hasn't exceeded the range of automobiles.
A diesel truck.
There's all kinds of automobiles. I mean, the Volkswagen,
like a hybrid,
Passat diesel went like 800 miles on a tank of gas because it got 50 miles, to the gallon.
Right.
I mean, and there's still, my wife's SUV, albeit it has 25 gallons, but it does into the mid-high 500 mile range. And so 500 miles isn't that big of a deal. But once electric cars can go further than what a gasoline car can go on a normal average tank size, I think that's a game changer.
More importantly, the infrastructure has to be there.
But you mentioned NVIDIA. You mentioned China and its issue with the chips, but a really big deal this last week was the deal. Really big deal was the deal with Japan.
Yes,
yeah,
15% tariff.
But more importantly, aren't they something that
people can now?
I've ever seen in my lifetime.
People might be able to buy the new Corvette and Mustang over there now too.
Well, Europe loves old Mustangs.
Yeah,
I know that. But yeah, that's a big deal. For our automobile manufacturers, that we're going to be able to sell our cars in Japan. Yeah, they've never been, as far as I know,
right.
maybe a long time ago, before Honda and Mitsubishi and Toyota and all of those became just the lifeblood, or at least one of the big
Honda and Toyota primarily. Yeah.
In Japan, but now you'll be able to buy, American cars, in Japan, which is huge. So it just gets back to this tariff thing, and what the original point of the tariff thing, was from President Trump wasn't to just, create, inflation with
conflict,
with consumer prices being increased because of tariffs on goods being imported in the United States. No, it was to
open the floodgates
for
open the doors,
U.S. exports, to go around the world, and for imports to be cheaper, or more importantly,
lower the bar.
Low, exactly. So that's a good thing financially, and quite frankly,
and hopefully
numbers. It hasn't affected jobs. It hasn't affected consumer spending. Minuscule effect on CPI, the consumer price index.
Yeah, not as much has been put out there.
Oh yeah, it's going to be the end of the world.
At the beginning of the year, well, how much is going to impact inflation, and so far it hasn't happened.
But what are we buying? Obviously, we're still buying individual bonds.
Well, I bought salami and I gave you one,
right?
So that's for sure.
Do we have some food companies in our clients' portalios?
Yeah, Cal-Maine.
Yeah, Cal-Maine,
which actually had a pretty good week too.
That's in the core.
Yep.
That's a good one.
Cal-Maine's in the core. We've already had that. Not buying more of that currently. Stocks right now is kind of tricky. I think, like as we said, things are pretty lofty right now. We're entering the slower, more volatile part of the season. So, being prudent on that end. But, I think with the pressure and the anticipation of the Fed's lowering rates and anticipation of rates starting to lower because inflation hasn't been pumped up like everybody thought it was going to be with this tariff action going on. You want to take advantage, if you haven't, of fixed income in the way of buying individual bonds instead of through funds and ETFs, because you can lock those in, and you're still seeing, fixed income and individual bonds in the fives. I mean, just a couple days ago, it was like 2-3 days ago, we're finding JP Morgan bonds, in the mid fives.
Yeah.
Which is great.
Even I thought it was even 5.6 if I saw the last couple
5.6, and you're not paying, these big premiums for these rates of returns.
They're very close to par.
It's close to par.
They're close to $1,000 per bond.
Some are actually at a disc. Some are actually still at a discount, and you're still getting a 5% or north of 5% coupon or interest rate.
It's unis recently for a client.
Yeah.
So if you have a high income, and taxes are a concern, the muni bond market is better than it's been in a long time.
Right.
And then of course, we love the alternative space, whether it's private credit, private equity, private debt, private real estate, so on and so forth. And some of these funds that we really like are absolutely crushing it. So for more information on maybe what you have already and aren't aware of, and for a no obligation consultation, give us a call at 916-967-3500. Again, that number is 916-967-3500. You've been listening to John Scambre and Giuseppe Viscani, the Wise Money Guys. Hope you enjoyed the show and hope you have a wonderful weekend.
Have a great weekend.